Hello folks, welcome back to CBOE. I am Dr. J from OptionMonster.com, and this is Time is Money. Let's take a look at what's going to be happening next week, starting with Apollo Group. This is one of those educational online facilities where people can go onto their campus from anywhere, and the stock reflects that people have been going back to school in big numbers. Look at this run. It's up from 62 to 78, so call it $16 in just the past 2 weeks alone. They have earnings Tuesday next week, the last trading day of the month of March. So keep an eye on APOL, Apollo Group. How are we playing this thing? We're doing a strangle. I'm selling the April 80 calls, and I'm selling the April 70 puts. That's $2 out of the money calls above the market, and selling $8 out of the money puts. And what happens if the stock stays between 70 and 80? I keep the entire premium. That premium, by the way, about $7.80. That's right, $7.80, about 10% of the value of the stock going into the earnings. That's what we're taking advantage of when we go in here and we buy stock and sell the out of the money call and out of the money put. We are becoming de facto the insurer for those people that want to protect their downside by puts, people that want to bet on the upside by calls. And so we're buying the stock, selling the out of the money call, selling the out of the money put. That means I'd effectively be exiting the stock at the strike price that we're selling, 80 plus $7.80, or nearly $88 a share, $10 higher than where that stock is right now, which would mean I'd have a $10 profit if the stock goes to 80 or higher. If it falls through 70 to the downside, that owner of that put could force stock into my account, and that would mean, of course, that I end up having to buy more shares, but at a significantly lower price. In fact, strike price is 70. I collected $7.80 for this combination call and put in the strangle. That means I'm effectively buying more shares at $61.20, $17 lower than where the stock's trading. So you can see why I have a very wide range that I make money with this strategy. But you need to understand the strategy. That's why you should open a paper trading account over at TradeMonster. You don't even have to fund it, and you can trade over at TradeMonster with fake money to see exactly how these strategies work out, and then say, boy, now that I understand them, I want to do that all the time. Here's another one. Lennar, home builder, higher from $6 to $11 just in the past 2 weeks as well. That's a $5 rally. It nearly doubled in the past 2 weeks. What am I doing in this case? I'm selling a straddle. That's the at the money call, the at the money put. The previous example, I sold an out of the money call and an out of the money put. This time we're selling a straddle. Right calls and puts, same strike. In this case, the 10 strike. I'm collecting $2.60 for it. I'm buying stock. So what does that mean? I own the stock. If the stock is 10 or higher, they're going to take it from me. If it's 10 or lower, I'm going to have stock put to me, and I'll be buying stock at basically $10 minus $2.60. That's $7.40 is where I'd be buying stock to the downside. Like that, if the stock's 10 or higher, I'm selling it at $12.60 because of the premium I collected for this. That's why this is such a powerful strategy, folks. Again, if you want to see exactly these kinds of graphics that I'm showing you here on to the right of the screen, if you want to see those, if you open up a paper trading account at TradeMonster, you can see every one of these straddles, strangles, covered rights, all of that, condors, butterflies, and you can trade them with simulated cash in your account. You don't even have to fund the account. Lastly, let me leave you with Monsanto. Earnings due Thursday next week. MON is the symbol here. And how am I taking advantage of this one into the earnings? I'm selling a put spread. Monsanto basically running up here into the higher numbers means I'm comfortable with the stock. It's still well off the highs of last year, but I'm selling a put spread, a credit spread on the put side. So what does that mean? Well, for instance, I'm selling the April 90 puts and I'm buying the April 85 puts. By selling the 90 puts, I am obligating myself to buy the stock at 90. By owning the 85 puts, I have the right to put it to somebody else at 85. That differential between those two strikes is $5, 90 to 85. I'm collecting right now $2.30 for that. I'm not doing this with any stock. I'm just selling this put spread and saying if it's 90 or higher, I keep it. I'm Dr. J from Option Monster. This has been Time is Money, brought to you by our sister company, TradeMonster.com.